Let's simulate a harsh reality. The calendar flips to January 2026. You check your banking app and see a flat line. Zero assets, zero investments, and perhaps a negative balance owed to creditors. The news cycle is relentless. Headlines screaming about the cost of living, artificial intelligence replacing workforce tiers, and real estate prices that seem completely detached from reality. In this environment, the natural human reaction is paralysis. You feel late to the party, assuming the wealth gap is now unbridgeable. But I want you to reframe this. Starting from zero in 2026 is not a disadvantage. It is a moment of clarity. You have no baggage, no underwater positions, and the ability to deploy capital into a new economic cycle with surgical precision. We aren't trying to get lucky quickly. We are engineering a mathematical inevitability to your first 6 figures. But before we look at a single stock ticker, we have to dismantle the obstacles that keep people poor. This phase is about mental leverage, not money. Scarcity thinking, impatience, and emotional decision-making are the real liabilities. Eliminate them, and you gain something more valuable than capital: control. From here, every move becomes intentional, compounding discipline instead of fear. The first step requires ignoring almost every piece of get-rich advice you see on social media. There is a dangerous trend where people with high-interest consumer debt are trying to invest in the stock market. They are chasing a 10% annual return in an S&P 500 ETF while paying 24% interest to a credit card company. This isn't investing. It is financial suicide. If you are starting from zero, you must understand that your net worth is likely negative. The stock market is not your friend yet. Your best investment opportunity is sitting right in your liabilities column. Until expensive debt is eliminated, every dollar you invest is quietly leaking value. Paying down high-interest obligations delivers a guaranteed, risk-free return that no market can match. This is the unglamorous foundation that separates people who build wealth from those who only talk about it. Think about it this way. If I told you there was an investment that guaranteed a 24% return with zero risk, you would sell everything to buy it. That investment exists. It's called paying off your credit cards. When you eliminate high-interest debt, you secure a return that no hedge fund manager can promise you. Furthermore, we have to talk about the mental toll of debt. It acts as a behavioral shackle. When you owe money, you operate from a place of fear. You don't take risks at work, you don't negotiate for higher pay, and you tolerate toxic environments because you cannot afford a disruption in income. Step 1 is the Scorched Earth Protocol. List your debts by interest rate, ignore the total balance, and attack the highest rate with every available cent. This buys you not just financial freedom, but psychological autonomy. Once this pressure is removed, your decision-making bandwidth expands. You begin to think long-term, act strategically, and regain leverage over your own time and choices. That clarity is the real compounding asset. Once the debt is incinerated, the temptation is to immediately throw cash into the market to catch up. This is the second point of failure. Most new investors are wiped out not because they picked the wrong stock, but because they had bad timing. Life is unpredictable. Transmissions fail, medical emergencies happen, and layoffs occur. If every dollar you own is locked in a volatile stock market, you will be forced to sell your assets, potentially at a loss, just to survive a crisis. You interrupt the compounding process. This is why liquidity matters before ambition. A cash buffer is not dead money. It is insurance against being forced into bad decisions at the worst possible moment. Stability is what allows compounding to actually compound. We need to build a defensive moat. Contrary to the cash is trash narrative, in the early stages of wealth building, cash is not an investment, it is insurance. We are building a liquidity shield, 3 to 6 months of bare-bones living expenses parked in a high-yield savings account. This boring, stagnant money has a superpower. It prevents you from being a forced seller. Consider 2 people during a market crash. Person A is fully invested with no cash. Person B has a cash shield. When the recession hits and both lose their income, Person A sells their stocks at the bottom to buy food, cementing a permanent loss. Person B lives off their cash shield, leaving their investments untouched to recover. The person with the cash shield wins simply by staying in the game. Survival is an underrated financial skill. Wealth is rarely destroyed by bad strategy. It is destroyed by bad timing under pressure. The liquidity shield absorbs shocks, so your long-term plan remains intact. Only when you are resilient to chaos do aggressive strategies actually work. Only after the debt is gone and the shield is built do we look at the offensive strategy. Here, conventional wisdom fails again. You will hear advice to diversify broadly, buy gold, crypto, international stocks, and bonds. But when you are investing your first $500 or $1,000, over-diversification is a trap. It dilutes your focus and guarantees average results. Diversification is for preserving wealth you have already built. Concentration is for building wealth from scratch. At this stage, your advantage is not capital. It is attention and time. A small portfolio cannot outperform by being spread thin. It must be intentional and asymmetric. The goal isn't to avoid volatility, but to ensure that when you are right, the impact actually matters. When your capital is small, you don't need to own the entire haystack. You need to identify high-conviction assets. Trying to find the next big thing is tempting, but spreading yourself too thin means that even if one asset doubles, it barely moves the needle on your total life. We need to reject the scattergun approach and adopt a sniper mentality. You are ready to enter the market, but you must do so with focus, not by blindly throwing darts at a board hoping to hit a winner. Precision beats activity at this level. A handful of well-researched positions, sized correctly, will outperform a chaotic basket of guesses. The objective is not constant action, but decisive action, where the upside justifies the risk. By 2026, the barrier to entry for smart investing will be lower than ever. You will have AI agents on your phone, promising to find the next Tesla before it breaks out. This is the alpha illusion. It relies on the arrogance that you, a retail investor with a smartphone, can outmaneuver institutional algorithms that trade in nanoseconds. The data is brutal. Over a 15-year horizon, nearly all active fund managers, who live and breathe this data, fail to beat the market average. If the pros can't do it, your odds are statistically indistinguishable from zero. Chasing this illusion is a trap. It encourages overtrading, emotional decisions, and exposure to risk without meaningful edge. True advantage comes from understanding the rules of compounding, positioning yourself in asymmetrical opportunities, and exploiting inefficiencies where humans, not machines, still hold the edge. The winning move in 2026 is to stop trying to find the needle and just buy the haystack. This is total market indexing. It guarantees you the market return, which historically doubles your money every 7 to 10 years. However, this strategy has a fatal flaw. It is excruciatingly boring. Real investing creates no dopamine. It is about as exciting as watching paint dry on a fence. Because we are hardwired to seek excitement, we often sabotage our portfolios by trading just to feel involved. To fix this, I use a containment strategy. I put 90% of my capital into boring automated index funds. I never touch them. The remaining 10% is my Vegas fund. I use it for high-risk bets, crypto, individual stocks, whatever the hype of the month is. If it goes to the moon, fantastic. If it goes to zero, my future is still secure. This satisfies the urge to gamble without burning down the house, allowing discipline and excitement to coexist without jeopardizing long-term growth. Once your asset allocation is set, we have to address the leak that drains more wealth than any market crash: the Internal Revenue Service. Most beginners obsess over what to buy, but they ignore where to hold it. If you build your wealth in a standard taxable brokerage account, you are taking on a silent partner who demands a cut of every win but rarely shares in your losses. This is tax drag, and over 3 decades, it can cost you 6 figures. The solution is simple but often overlooked. Use tax-advantaged accounts wherever possible. Roth IRAs, 401s, Ks, and other deferred or exempt accounts act like a shield against this silent erosion. Your investments can grow uninterrupted, compounding unhindered, while Uncle Sam only collects when you choose, not when he decides. proper placement is as powerful as proper selection. We need to optimize asset location. The government offers tax shelters, 401s, Ks, and IRAs, to incentivize us to look after our future selves. Many people avoid these because they fear locking up their money until age 59. They value flexibility over efficiency. This is a mistake. The penalty for early withdrawal isn't a bug, it's a feature. It acts as a behavioral guardrail that prevents current you from robbing future you to buy a depreciating luxury car. The protocol here is a specific waterfall. First, capture the employer match on your 401(k). That is an instant 100% return. Second, max out a Roth IRA for tax-free growth. Third, utilize an HSA if eligible. Only after these buckets are overflowing do you return to a taxable account. This hierarchy ensures that you keep what you kill, compounding not just capital, but discipline, so your future self receives the full benefit of your early sacrifice. Finally, we arrive at the harsh truth of the spreadsheet. You can optimize your debt, perfect your portfolio, and minimize your taxes, but you cannot budget your way to millions if your income is stagnant. There is a mathematical floor to how much you can cut expenses. You have to eat and sleep somewhere. But there is no mathematical ceiling on how much you can earn. The only way to escape the compounding limits of frugality is to focus on increasing your earning power. Invest in skills, build businesses, leverage technology, and find ways to scale your time. Money follows value creation. The richer your skill set and network, the higher your ceiling becomes. Frugality preserves your base, but income growth accelerates your trajectory. Too many people play a defensive game, obsessing over canceling a $15 streaming service while ignoring the fact that their primary income holds them back. In the economy of 2026, you need to play offense. This doesn't mean driving for Uber or delivering food. Those are low-leverage activities that trade time for linear cash. You need asymmetric bets on your skills. A $2,000 raise achieved by learning a new software or certification is worth infinitely more than $2,000 earned from a side hustle because the raise compounds. It increases your 401(k) match, your social security basis, and your future negotiating power. Focus on leverage, not hours. Investments in yourself, the rare skills, certifications, or networks that multiply your earning potential, create exponential returns. Time spent upgrading your capacity yields far greater long-term wealth than any short-term hustle ever could. So, the blueprint for the 2026 reset is clear. It is not about magic tricks. It is a sequence of operations. Ruthlessly eliminate high-interest debt to stop the bleeding. Build a liquidity shield to prevent forced selling. Automate your investments into boring index funds to remove human error. Shield those assets from taxes using the government's own rulebook. And finally, aggressively reinvest in your own skill stack to increase the velocity of money flowing into the system. This is not a gamble. It's a framework engineered for inevitability. Each step compounds the previous one, transforming discipline into momentum. Follow the sequence with consistency, and what once felt impossible, financial freedom from zero in 2026, becomes a predictable outcome rather than a hope. This path is simple, but it is not easy. It requires doing the opposite of what the crowd does. If this roadmap gave you a clearer vision for the year ahead, make sure to subscribe so you don't miss the next deep dive. Now, I want to hear from you. Be honest. Would you rather have a guaranteed boring 10% return for life, or a 50-50 shot at doubling your money overnight? Let me know your risk tolerance in the comments below.